makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London for Francine Lacqua. Now let's check in on these pre-market movers, shall we? We have moves for Broadcom after Bloomberg learned that Broadcom's helping OpenAI design and produce an AI accelerator chip from next year. They're getting into this lucrative sphere that's been dominated, of course, by Nvidia. And the chipmaker also reporting third quarter results that beat expectations on AI semiconductor revenue. The CEO pointing to a strong AI outlook. So you can see Broadcom shares up 6% there, but disappointment for Lululemon. Look at that, down nearly 17%. They slashed their output, disappointing investors for a third straight quarter as they really struggled to meet the high expectations of the company and to balance tariff expenses. Now, this Wall Street stock rally is extended into Asia as further signs of a cooling labour market have reinforced those bets that the Fed's going to cut rates later this month. The Fed's John Williams says that he expects rates will come down eventually.
Looking ahead, if progress on our dual mandate goals continues as in my baseline forecast, I anticipate it will become appropriate to move interest rates towards a more neutral stance over time.
Well, joining me now is Emmanuel, co-head of European equity strategy over at Barclays. Happy September to you, Emmanuel.
Thank you, Lizzie.
It's usually the time of year when we're cautious when it comes to equities, but you, I see, are telling everyone to buy the dip. Why?
Yeah, look, we still believe the growth policy trade-off is decent, right? So I think in the US, the direction of travel is very clear. You know, the Fed is going to cut rate. I know there's a lot of concern about their independence, but we think they have good reason to cut rate. The job market is softening, but not enough yet to really revive this kind of recession worries. It's not too hot, not too cold. Data thing is keeping the Goldilocks narrative on track for now.
Well, yeah, that's what I want to ask you, because why is bad news necessarily good news? Is the prospect of Fed cuts enough to, grow the economy and to juice this market?
I mean, this is obviously the narrative for now. So there's a big number coming out today with payrolls. I think we need either very hot or very cold data to derail this Goldilocks narrative. At some point, bad will be bad, right? So I think we need to be careful what we are wishing for. We need to see some softening in the data for the Fed to cut rates. They won't be cutting rate if growth is flying. But at some point, if the data is really slowing, I think the market will start to question whether the Fed isn't too late, right? So far, we think there is a window for the Fed to cut rate preemptively and reassure the market on their intention to prevent a meaningful shock to the economy.
But you touched on Fed independence. When you think about the source of that jobs data, the BLS, obviously the president fired its boss. So how much credibility does the payrolls data actually have, especially as we had all those revisions last time?
Look, it has to be put in a context of other indicators, I think, from different sources, private sources, showing that labor market is slowing, right? So we got ADP data yesterday, jobless claims showing some increase as well. ISM survey were pointing to a slower market condition as well in employment. So, look, across the board, I think the signs are pretty clear that, there is some degree of softening in the labor market. But, of course, the market might be a bit more concerned about the quality of the data. But I think for now, all the indicators are pointing to a fair amount of softening in the job market.
But, of course, it's not all about the macro. Are you not worried about valuations?
Look, there are a lot of things to worry about. I would say I would put valuation in the context of two things. Firstly, real rates are coming down, which is obviously a support to valuation. Secondly, earnings are still doing the heavy lifting. Earnings are growing. S&P EPS beat estimate by $5 in Q2. And we are seeing earnings revision across the board in the US, but also in Europe now, starting to inflect higher, right? So I think that's why we are seeing this pretty decent growth policy setup where policy is getting a bit more supportive with the Fed likely to cut rate. At the same time, growth and earnings holding up, which is a pretty decent setup for the equity market.
OK, so everything's perfect for you so far, Emmanuel. But when we look at big tech specifically, you had those underwhelming earnings from Nvidia, as some would put it, uninspiring, shall we say. Then you've got this renewed threat from DeepSeek. It's got its AI agent getting ready for the end of the year. How much of a threat does that pose to the Mag 7, and how much does it make you want to look elsewhere to China?
Look, I think there are issues that this concentration may, put the broader market at risk if there are no alternative to AI and Mag 7. So the threat has as you said, were maybe a bit of fatigue with AI, high valuation, very crowding positioning, plus this competition from Chinese AI, right? So this is something which might prompt a bit of unwind of de-risking on the space. I would say, luckily, there's a bit more, I think, opportunity to invest elsewhere and play a bit of rotation into some of the laggards. That's why I think the Fed put is very important, because if the Fed is in a position to cut interest rate and to prevent a hard landing of the economy, we might see some of the lagging part of the equity market, the S&P 493 basically, starting to catch a bit. And we've seen basically in the last 4 or 5 weeks already, small caps, for example, performing better after underperforming for many, many years. So I think this easing in financial condition, while growth is still decent, is helping a bit of broadening out of big tech and some, rotation into some of the maybe shorter cycle type of stocks.
And how far do you take that broadening out then? Do you go even into Europe as well?
Look, I think Europe has a different narrative. Europe has been the kind of shiny market in the first half of the year. I think it was just a bit of luck that people were keen to sell tech at the start of the year. There was this DeepSeek moment, and investors were rotating into tech-light indices, which did benefit Europe. What we saw over the last 6 months already is Europe losing some of this Q1 and outperformance, largely because of concern about tariff, global trade, global demand, and the strength in the currency. So now we are back to a point where Europe has mostly lost their outperformance for the year. 2 things. Obviously, you have the domestic concern about politics. France has a number of event risks next week. People are quite worried about the execution on the German stimulus as well. And we've seen some issue with earnings being cut meaningfully on the back of this euro appreciation.
But on France, you mentioned the political risk. The CAC's so internationally exposed. Is it really going to have that much of an effect?
Well, I think that's what I was about to say, that if, for Europe, somewhat counterintuitively, even though we may have some domestic issues, as long as we see some green shot in US consumer, in Chinese data, and euro start to stabilize, we might start to see a bit of catch up from some of these cyclical exporters. And this is basically in line with our recommendation. We've been reducing our domestic exposure to Europe. We cut, for example, utilities earlier this week to add back to some of these global cycle plays like industrials or tech after a pretty weak performance in the last few months.
And I see that you overweight the FTSE 100, right? Why bother with equities at all, Emmanuel, when you've got long end gilt yields yielding, let me have a look, today, 10-year yield, 4.7%?
Look, bad news for the UK are usually good news for the FTSE 100, which is a very internationally geared index. So, yes, I think there's going to be a lot of noise into the 26th of November budget. It's hard to see anything good happening because the Chancellor has to keep the bond market happy, which means that they would have to come up with some degree of fiscal tightening, in my view, which might put pressure on the more domestic part of the UK equity market, who are nervous, quite bearish on the FTSE 250, but the FTSE 100 is much more leveraged to global demand and has this tailwind from potentially weaker currencies. So that's why we think FTSE 100 as a more defensive and export-driven index can perform even with the domestic noise constraining the mood on the UK markets.
OK, well, Emmanuel, great to have you with us. We've got the FTSE 100 up 0.25% as things stand. But good to see you. The head of European equity strategy over at Barclays, Emmanuel. Now, to some breaking lines on the terminal out of China. China is going to adopt anti-dumping measures on pork that's coming from the European Union. They say that they're going to collect up to 62.4% deposits on EU pork, and China issuing these preliminary results on the EU pork probe. So this is the latest on the trade story. 62.4% is the red head, the number of the levy that they're going to be charging. But let's get back to the Fed story. Stephen Miron, President Donald Trump's pick for the Fed's Board of Governors, has pushed back against Democratic concerns that he would do Trump's bidding at the central bank. Democrats also raised concerns that Miron's decision to stay on the White House payroll, albeit unpaid, while also serving at the Federal Reserve, could compromise his independence.
Look, the president nominated me because I have policy views that I suppose that he liked. If I'm confirmed to this role, I will act independently, as the Federal Reserve always does, based on my own personal analysis of economic data, my own personal analysis of the effects of economic policies upon the economy, and act based on my judgment of the best economic policy possible.
Let's get analysis now with Bloomberg's Ros Matheson. Ros, we watched that. We knew who was going to defend Fed independence. But what we want to know is Stephen Myron going to be confirmed for the September meeting? And is he going to be pushing for a half-point cut?
Well, the second part is kind of the really interesting question, because it does seem as though he's going to get through. I mean, none of the Republicans on this committee seemingly wanted, raise the hackles of Donald Trump by publicly opposing this nomination. And of course, he was going to get grilled by the Democrats on it. I mean, there are signs of unease amongst some of the Republicans about this, but in the aftermath, there was no indication that they're going to try and block that. And the idea is to fast track it through. So, in fact, he can be part of the September rate decision. And the question is, does he try and push for 50 basis points? If so, I mean, the US Treasury Secretary Scott Bessent has been quite vocal in saying that the Fed should consider 50 basis points at this meeting. Does he sort of tip his hat to that in a minute? But again, he would be one voice still, in the whole cacophony of Fed voices on this decision. And for the Fed, going 50 basis points would be a big move, and risk the Fed, being accused then of responding to politics versus responding to pure economics. I mean, a rate cut is on the table at this meeting, especially, again, depending what we see with payrolls today. But there's a big difference between 25 and 50, and most people in the Fed clearly know that.
Well, the other bit of drama that's happening at the Fed, of course, is around Lisa Cook, the other Fed governor, and the Justice Department actually stepping up and launching a criminal investigation. So are we going to see her on the Fed board when it comes to the September meeting?
Well, for now, the most important thing is the legal case against her. The DOJ has opened this criminal probe, which was possibly not that surprising. It was heading in that direction. The question is, how quickly does that move alongside the legal case that we've got going on? And we know, of course, that we had the US administration filing further details yesterday in their claim against her. But the judge in that case hasn't given a sense of when they plan to rule. It could be next week, whether this is basically on that idea of the injunction and where to go from there, or do they punt it even closer to the Fed decision. But in theory, she's able to stay in place until at least that ruling happens. And so if it comes next week, that could have ramifications for her, or does it get dragged on ever closer to the Fed meeting?
OK, Bloomberg's Rosalind Matheson, we thank you so much. Well, we also have breaking lines out of Ørsted. We were talking about legal issues around the US government, and Ørsted, of course, suing the US government as it tries to revive the building of its offshore wind farm in New England. We have a redhead that Ørsted shareholders have approved the rights issue after a profit warning. We'll get more on that in just a moment, as well as we'll ask the question whether Europe has become any more competitive after a year after the Draghi report. We'll get your assessment next. This is Bloomberg. So, Ørsted shares up 0.8% after shareholders voted to support a crucial 60 billion Danish kroner rights offering just after the company issued a fresh profit warning on Friday. Now, the Danish wind developer is asking for almost 3/4 of its market value in new capital after all the turmoil that, of course, has been caused by President Trump's efforts to halt the development of their offshore wind farms. So, the stock on the front foot this morning. Let's stay in Europe and turn to France, where Prime Minister François Bayrou says that he doesn't regret calling a confidence vote, putting his government on the line, as France is burdened with debt, in his words, and the political parties, as he says, must each take responsibility. Now, in this interview on French TV, he said that he was, quote, putting the future of the government on the table. This as French President Emmanuel Macron says that he'll seek to avoid a snap election if Bayrou loses. We can speak now to Jean Dalbar, who is economist for Bloomberg Economics, and he's been looking into all of the possible likely fallouts for us. So, hey again, Jean. Just walk us through the different scenarios for France and your new uncertainty index, what it says about what could happen.
Sure, absolutely. No, France is facing a new political crisis, and it is particularly striking if you look at our new economic policy uncertainty index that has skyrocketed over the past week. So it pretty much illustrates the intensity of the political crisis France is facing. And indeed, we expect the government to collapse next week during a confidence vote at Parliament on Monday. And then we would expect President Macron to appoint a new prime minister that would lean toward the center-left in a way to find a deal with the current coalition on the budget. So that's our main scenario. The main risk would be for President Macron to instead call for snap elections, which would lead to, in our view, a new fragmented parliament and probably a new government led by the far-right party.
Okay, Jean, thank you so much. Jean Dalbach from Bloomberg Economics with that look ahead to Monday's confidence vote. Now, it's almost a year since former ECB President Mario Draghi issued an influential report on European competitiveness. It provided detailed recommendations, as you'll remember, to the European Commission on creating a capital markets union and funding innovation, funding growth. So what's changed 12 months later? Joining us now for an assessment is Sander Tordoir, Chief Economist at the Centre for European Reform. Sander, good morning. It's back to school season, so it's time to mark Europe's homework. What grade would you give them on the assignment from Draghi?
I think, fundamentally his quite dire diagnosis last year has only been brought home more this year. Europe's energy problems are brought to the fore more by the energy needs of AI, where Europe was already lagging. The kind of economic coercion from the US and China has really hit home in this, what some call the summer of humiliation, despite Europe being an economy of roughly equivalent size. And that really also hurts in an area where Europe is still very strong, manufacturing, where the trade war kind of is at its most intense, even though Europe's manufacturing as a share of GDP is 16% versus 11% in the US. And Europe has twice as many manufacturing jobs as the US. And so you see kind of across the board that Draghi's diagnosis, perhaps most importantly, the lagging innovation in Europe is really clear. And Draghi himself last week gave a quite harsh speech where he said that Europe's illusion that it could project power has been exposed because of its economic weaknesses.
And we had German factory orders this morning unexpectedly slumping, the most since January, Sander. Are we overestimating the rearmament push and the fiscal boost and how much that could outweigh the tariff hit to the European economy?
Yeah, I think these are really kind of factors pulling in different directions. We obviously have Germany's fiscal revolution, the 1 trillion in investment in infrastructure and defense, which is a positive boost for European industry. But at the same time, the tariff hits are real. And China is a major player in terms of choking off European export markets and being a really formidable competitor on the European market for European industry. And you just have to look at China's trade surpluses, its manufacturing trade surplus, which is approaching $2 trillion. And this is really now in the same kind of sectors where Europe and Germany tend to excel, so cars, machine building, chemicals. And so all these factors are balancing each other out. But for now, there's more pain coming. I would also add that the German fiscal package hasn't really happened yet, right? It's quite slow moving. And so that support is still coming. But in principle, Europe should be able to replace some of the lost external demand from the US and China with domestic demand. Total exports to China and the US are only 4% of EU GDP. That's sizable, but it's not insurmountable.
Yeah, and that call for the self-sufficiency of the European economy, really fundamental to the Draghi report. But if we can also turn to France, because we were just discussing with Jean the consequences of the confidence vote on Monday. Do you see the political crisis becoming a debt crisis and an economic crisis for France?
I personally don't. I think the French crisis is really an issue of not being able to get its deficit under control on a French economy that's still diversified, that is, has underlying strengths, but France is really unable politically to exude a sense of control on this deficit. And I think it speaks a bit to a wider issue in European fiscal. So I think many of us are optimistic about Germany changing its fiscal policy in an environment where it can no longer rely so much on global trade. But at the same time, the composition of fiscal policies in the Eurozone, which has long plagued the continent, is not really improving. You don't want France to basically follow the German example because it has a much higher debt level. And there's some hope that the Nordics, Scandinavia, I would include the Netherlands, and Poland, which are really going to drive Europe's rearmament drive because they have the fiscal space for it. But there, that kind of engine is also still waiting to really kick in, which would provide some space for the high debt countries of Europe to maybe consolidate a bit. But as always, the composition is really the issue more than the overall debt level of the European continent.
And Sander, we had Jackie Ineke on yesterday talking about how Brussels is really just dragging its feet when it comes to the Capital Markets Union. Why do you think that is?
Look, I mean, Renew Europe, the liberal parties of the continent, have just released a report showing that of Draghi's recommendations, only around 11 or 12% are implemented. So I would agree with you, there's some feet dragging there. You know, I'm personally a bit distraught by the fact that Germany is opposing UniCredit's takeover of Commerzbank, because in many ways Europe's incomplete banking union is the trailblazer for capital markets union. And if we don't make progress on the former, it's hard to see financial integration on the latter. And I think many member states, you know, and that holds also for other policy files, are sort of stuck in the narcissism of small differences. They're afraid of having more capital market competition, even though in the aggregate for all of them it would be better to integrate capital markets. So there's some short-sightedness on that front.
OK, well, there are so many recommendations in this report. I've got to ask you, and I only say this partly tongue-in-cheek, is the real reason why Draghi's report is so far from completion in Europe that it was just too big and too detailed?
I mean, in some ways one could argue that. I think you could flip it around and say the value add of the report was that it actually provides a quite comprehensive, coherent roadmap for Europe to make progress. And I would argue Draghi at least didn't mince his words. I mean, the messages were punchy, the recommendations are actionable. And of course, there are just many issues that Europe is facing. So I don't think it's really a mistake of Draghi's strategy. One issue in some ways is that Draghi himself doesn't have a role. He could have maybe become European Council president, that may have helped. But fundamentally, the power in the EU really lies with the Commission and the member states, and they have to act on these recommendations. I wouldn't say nothing has happened. We discussed German fiscal. There's some macroeconomic adjustment. There's some movement on industrial policy. You just mentioned Ørsted. In other areas of the wind sector, Europe is stepping up to counter China's non-market distortions, but it's quite still haphazard and piecemeal.
OK, Sander Tordoir, Chief Economist at the Centre for European Reform. Great to have you with us on a Friday. Hope you have a great weekend. We're looking at the performance across Europe. It's green across the screen as things stand. The Stock 600 up 0.3%, the DAX up 0.2%. But all of this could change, of course, as we get payrolls later. But before that, we're going to talk about the oil market with an OPEC Plus meeting this weekend. So stay with us for the details. This is Bloomberg. Good morning and welcome to The Pulse. I'm Lizzie Burden in London, and these are your top stories. Jobs day in the USA. Stocks rise as traders look for a rate cut confirmation after more signs of a cooling US labour market. And Stephen Myron says that he's committed to central bank independence. President Trump's pick to fill a vacant seat on the Fed's Board of Governors is grilled in a confirmation hearing. Plus, taking on Nvidia. Broadcom said to be helping OpenAI to design and produce AI chips. Well, we've got European leaders pledging to provide security guarantees for Ukraine if a ceasefire takes hold, with 26 countries prepared to contribute, including troops.
Cette coalition des volontaires qui
This coalition of the willing, which is a coalition for peace, has indeed today put on the table and clarified with a military and political commitment the contribution of the 35 members in order to provide these guarantees of peace and security to Ukraine.
Our Europe correspondent Oliver Crook has the latest. Ollie, Macron there keen to emphasise that the coalition of the willing isn't waging war on Russia. So what is its plan?
Yeah, so we got a little bit more clarity on what has been a very ambiguous, though very sort of a sensationalist idea about security guarantees for the Ukrainians in the day after process of peace and ceasefire from the Europeans. We've been talking about this coalition of the willing. We've been talking about this reassurance force. We've had very little detail on what it includes, what its purview is going to be, who's going to be involved. So we have a little bit more detail on that. So a reminder, this coalition of the willing is now a 35-nation-strong initiative that is spearheaded by Keir Starmer and Emmanuel Macron, assembled yesterday in Paris with Zelensky, as you can see right there, with two sort of main pillars for the security guarantees. The first is ways to basically buttress the Ukrainian military by giving them more support financially and with hardware, that sort of thing. But the second part is this reassurance fort, which, as now we understand from Emmanuel Macron, who gave a press conference after the meeting, that now there are 26 nations, 26 of the 35, that are willing to commit troops in some capacity in Ukraine, on the ground, on the sea, in the skies, in order to deter Russia from any further aggression in the future in the event of a peace deal or a ceasefire. So that is now apparently a hard sort of a guarantee from some of these nations. The issue here, Lizzie, is of course that politically this is very difficult for a number of these countries. We are now getting these assurances. Even the Germans have been very reticent to sign up to anything like this. But we should say that the two sort of nations that are spearheading this project are politically very fragile at home, and both have massive budget crises that are creating massive problems in the bond markets, and in the case of France, pulling down the government. So there's a big question of how to pay for it, to say nothing of the fact that any question of security guarantees is dependent on a peace deal on the sort of the day after, and we're still very much in the day of as far as the war is concerned. So what everybody is going to be looking to is Donald Trump and whether or not he has the appetite to begin putting more pressure on Russia in the form of secondary sanctions on the countries that still buy Russian crude oil.
And meanwhile, Ollie, I want to get your take on this news from China announcing hefty levies on EU pork imports. Do you want to put some meat on the bones of this announcement for us?
Yeah, absolutely, Lizzie. I mean, listen, we thought the trade war was over, right? That Liberation Day had come and gone. We got all the negotiations done. We had a fairly clear idea of these sort of trade regimes between the United States and the rest of the world. But we forgot about the other trade war that's going on. There's still one that is sort of going on between Europe and China. You'll remember that last year you had those massive tariffs imposed by the European Union on Chinese EVs. And now you have a preliminary imposition of tariffs from the Chinese, looking to put tariffs on pork specifically in the range of 15.6% and 62.4% in pork coming from the EU into China. This obviously is a very wide range. It is still a preliminary discussion. This is partially due to the fact that the Chinese are way oversupplied on pork domestically, and consumption locally is not all there. But again, it serves as a reminder that the sort of only protagonist in the room is not just Donald Trump and the United States. There are a litany of other sort of geopolitical issues going on in the world, a fact that I think we've all probably been reminded of over the last 72 hours with that impressive military parade we saw in China and all of the sort of hand-holding and hugging that was happening in Beijing over the last few days.
Indeed. Bloomberg's Oliver Crook bringing home the bacon for us. We thank you so much. Now, we've got one eye on the geopolitics, of course, especially if you're an oil trader, but you've also got an eye on this OPEC Plus meeting that's coming up. A supply in focus. You could see the group signing off on another production hike. To discuss further, I'm joined now by Michael Haigh, Head of FIC and Commodities Research over at SGCIB. Really good to have you with me on this Friday morning. Let me just start with the timing of this meeting.
Yeah.
Do you read anything into the fact that it's a bit later than usual?
I would have done if there wasn't so much else going on.
Yeah.
Because normally what happens is that OPEC, when they're deciding to change their production, they do this between the 3rd and the 5th of the month, maybe the 6th at the latest. Our meeting is on the 7th. Why do they do that? Well, that's sort of to get ahead of the nomination finalization between buyers and sellers for the next month. So ordinarily, I would have thought pushing it back means people put their nominations in place and they're not going to do anything with their production, but not so sure anymore.
And given how much they've already returned, do you really think that they could bring more back?
So on paper, they've returned 2.2 million barrels a day from April to September, but the reality is that that hasn't hit the market. In fact, only about 1 million barrels a day has come out of those countries in terms of exports, and China has mopped up a lot of that in terms of its SPR rather than its commercial demand. So inventories are still pretty low. We've had a very weak seasonal period. Strong seasonal period. We're about to enter into a weak period.
Yeah, after travel season, right?
Exactly, and Middle East burning, etc., for air cooling. But once you get into the fall, demand's going to be a little bit weaker. So if you want to strike and you want to make changes, now's probably the time to do it.
Yeah, so what happens in the market if they surprise us, either by holding back supply or accelerating the return?
So in all probability, if they're going to do anything, they're either going to hold or accelerate return. Let's assume they accelerate return, and it starts in October, and they say 1.66 million barrels is going to come back, let's say, spread over 6 or 12 months. That's not a tremendous amount. But the other thing to realize, and I'll get to the market impact in just a second, that 1.66 won't come back. Because of that, 500 is Saudi, 500 is Russia, and the rest amongst all the other countries, including Iraq. And they're maxed out, infrastructure issues or just production issues. So it won't come back. Maybe half of that will come back. But what would be the market reaction on Monday as a result of OPEC saying, we're going to bring back 1.66? I think the market would factor that entire amount in.
Okay.
You'd see prices drop, and then there'll be a realization shortly after that those volumes actually won't be that impactful and it won't be that much. You'd get some sort of return back to where we are, but definitely a bearish move.
So not on Monday, but longer term, Goldman's seeing Brent dropping all the way to the 50s.
Yeah.
But what I want to know is where that leaves the US shale patch.
That's not good news for the shale patch, obviously, because, I mean, you can't have it both ways. You can't have drill, baby, drill and have more, because these companies won't respond to that. In fact, the Dallas Fed survey back in June painted a very dire picture for the outlook for the US shale patch. So if you go down into the 50s, which is actually what we think will happen by the end of next year, this is not good for shale. So shale, about 125,000 barrels a day this year of production. Next year, 50,000 if you're lucky.
And what's your read on demand? Because, of course, we also get payrolls later. So how does that factor into your forecast of the 50s?
So demand is pretty bad in oil. So this year and next year, we're looking at about 700,000 barrels a day of growth. China is down to 85,000. It used to be 1.5 million. So it's pretty bad. And, of course, you've got India, which is the highest growth market now, over and above China. And, of course, you've got tariffs on India, 50% tariffs. So their GDP is going to take a bit of a hit, which is going to hit the oil demand, probably more than the reaction from, say, non-farm payroll.
Yeah, I wanted to get to India, because Ollie was talking about the hand-holding that was going on, and India is cozying up to Russia. Does that surprise you when you've got such pressure from Donald Trump?
Well, I mean, there's a few kind of weird things going on. Obviously, there's tariffs on India because they buy the Russian oil.
But is it worth it, the discount of Russian oil, when you've got so much US trade?
If you take the discount of landed India prices minus Brent, let's call that $3-4, and you multiply it by 1.5 million barrels of imports a day, and you trace that over the course of a year, you're talking like 3 billion, maybe 4. Could blow out to 10 billion if you get a $10 discount. So net, it probably doesn't offset the decline you get in terms of GDP. But the other thing I wanted to point out is that while you've got tariffs on India, because they're buying Russian oil, India still exports the products to the United States. Not very much, but a little bit. So there's a bit of a conundrum there to sort out.
Just finally, Michael, I want to get your take on gold, because you've got markets now almost fully pricing in a Fed cut.
Yeah.
And, you know, we've seen these record moves on gold. How much more upside is there if, you know, you've got the threats to the Fed independence and the Fed cuts fully priced in? That's a big if.
So, actually, the gold market has basically ignored these factors for the last year and a half. It's mainly about ETF flows, central bank buying. Of course, these things matter at the margin, but the summer is actually a lull in central bank buying of gold. So it's actually really come down a lot. ETF flying purchases have been resilient, even though uncertainty has come down, however you want to measure uncertainty. So I believe that coming out of the summer, in September onwards, you'll start to see more central bank buying. Of course, lower interest rates in the US are positive for gold. So I just see it keep on going towards its path towards 4,000.
Well, let's see what happens after that payrolls number, shall we? Michael Haigh, Head of FIC and Commodities Research over at SGCIB. Great to have you with me. We thank you. Now, Denmark's central bank governor says that it's to cut its economic outlook for 2025 substantially because of weaker sales growth at Novo Nordisk, the country's biggest company. Christian Kettle-Thompson sat down with Bloomberg's Sanne Vass at the bank's HQ in Copenhagen for an exclusive interview.
This is due to two things. And probably we will reduce it quite significantly, and we've seen that from other forecasters who have come out recently, the Ministry of Economics, which reduced it from 3.5 0.5 around to 1.4 actually. But there's sort of two different aspects to this. One is what sort of impacts the growth forecast going forward. And I can come back to that. But then there's also that because of revised national accounts and slower growth in the beginning of this year, we will have to put it down. But that doesn't really impact things going forward. Going forward, it will particularly be the effects of tariffs, as we talked about before, the U.S. tariffs, and also there will be an effect from this, from the Novo Nordisk sort of lower sales growth forwardly. Some of this from the Novo part will be in the U.S., but still it will reduce Danish growth going forward. But it's not so that it's not a completely different growth picture as the numbers might indicate. If you go from 3.6 to around 2 or something, then it's not as dramatic as that.
That was Christian Kettle-Thomsen, Governor of the Danish Central Bank, speaking to Bloomberg's Sanne Vass. Now, Bloomberg's hosting an exclusive live conversation, Q&A, on Novo Nordisk this afternoon. At the centre of that interview, of course, the blockbuster Successor, Ozempic and Wegovy, having made Novo at one time seem unstoppable. But now the drug maker faces a host of challenges. So our reporters will be answering your questions from 1 p.m. London time this afternoon. Just head to Bloomberg.com. Now, to the UK, 12,000 members of the Populist Reform Party in the UK are gathering in Birmingham later for a two-day conference, a key test for leader Nigel Farage. Now, Reform, which has led opinion polls in recent months, has grown rapidly and now has almost 240,000 members. Well, to the UK economy now, and it's been a tumultuous week for the gilt market. Politics, in part, sending those 30-year gilt yields to levels not seen this century this week. And the BOE is actually proposing to help, if needed, to prevent a repeat of the Liz Truss crisis back in 2022. We're joined now by our Bloomberg UK economy reporter, Phil Aldrich, for more. Phil, despite the efforts to tame market risks, this isn't quite an end to active gilt sales from the BOE, is it? Or is it?
No, there is. We don't know, actually. We're going to find out in the coming weeks. On September the 18th, we're going to find out what the Bank of England is going to do about the gilt sale stuff, the QT programme. The markets currently, investors currently expect the portfolio, which has been running at 100 billion a year of sales or of unwinding, to be reduced to about 75 billion pounds. That would imply that there will be further gilt sales in the coming year. If Bailey wants to give the markets a jolt to avoid further shifts upward in the yield curve, then he might end active gilt sales altogether. That would be a huge step for the bank, because obviously they've been very, very firm that gilt sales has been part of of the clear strategy to reduce this portfolio, which they're in a hurry to do, basically.
But of course, he's been saying don't worry too much about these long end moves. Andrew Bailey trying to throw water on that fire. Exactly. Meanwhile, though, we've got the fiscal worries and investors worried about the doom loop that many say we're in, where you've got higher taxes, you've got lower growth. And just this morning, we saw the retail sales numbers revised down for the first half of the year. But, when spending cuts aren't politically palatable, I do just wonder what's the way out here at the budget? What are you hearing?
So, growth. It's the perennial option that every politician turns to, which is growth. It's the easy way out. And so, they do want. So the big challenge that Reeves and the Treasury face is that the Office for Budget Responsibility is expected to do some manner of downgrade, and that downgrade is going to be more damaging than the U-turns on welfare and the higher borrowing costs. So potentially, they need to offset this downgrade with growth policies. So I think there will be in the coming weeks a succession of growth policies to try and just show the OBR and just general investors that this country that the government is absolutely laser focused on the growth mission. But they cannot avoid the inevitable, which is that there's going to be a big hole in the public finances. So she's going to need to do tax rises. I think the tax rises everybody's expecting. I think it's inevitable, but there'll probably be some degree of spending restraint in there as well. And obviously when you talk to economists, the preferred way of going about these tax rises is actually to delay them as much as you can, so you don't hit the growth in the short term, but you do fix the public finances in year 4 when the target has to be hit, and so you can do that by extending the tax threshold for the frozen tax threshold for another 2 years, so it doesn't affect people's pay packages until 2028. And you could do some of the fiscal fiction on spending cuts in the final year after the spending review closes in 2029. So there's a final year where they could just reduce the amount of spending penciled in for public services at that point. So there's things that they can do to try and get money without hitting growth in the short term.
Yeah, but none of it particularly politically palatable in any case. I just also want to talk about those retail sales numbers because, to have revisions like this, it echoes what's happening in the US with the Bureau of Labour Statistics, which of course is in focus because we've got the jobs data later. How significant is it that they're having to do this, and how much should we read into it, that they're changing the narrative so much? Because we thought that the British consumer was getting back on his feet.
Yeah, 2 billion less has been spent than in the first half than had previously been thought. So, yeah, consumption is a chunky bit lower. So that unravels some of the positive news that we've had, because we are still growing, if the data is to be believed, at the fastest rate in the G7 in the first half of this year. Consumption is the real hope, because households have got a lot of savings. The savings ratio is much higher than it would normally be. Businesses have got a lot of cash sitting on their books. So the private sector, the households and business sector, are relatively strong, and they can come to the rescue of this economy by spending. So the fact that the consumer numbers went backwards is certainly not good news.
Well, that's exactly what I intend to do this weekend: spend. Bloomberg UK economy reporter Phil Aldrich, we thank you so much. Well, coming up on the programme, we're going to turn to tech. Broadcom shares soaring on a report that it's helping OpenAI to create an AI chip to take on Nvidia. We'll get you the details next. This is Bloomberg. Now, Bloomberg has learned that Broadcom is helping OpenAI to design and produce an AI accelerator chip from next year, getting into a lucrative sphere dominated by Nvidia. The chip maker's surging in the pre-market, with the two firms planning to ship the first chips starting next year. Joining me for more is our anchor of Bloomberg Tech Europe, Tom McKenzie. So, Tom, just talk us through the significance of this announcement between Broadcom and OpenAI.
Well, the time frame that you outlined there is really important. So 2026, that's pretty accelerated. So the product is going to be produced and designed in partnership between OpenAI and Broadcom on this reporting. It will be an AI accelerator. It's likely to be used by OpenAI in-house to start with. There's a question mark there then. Later on, does OpenAI start to put that onto the market for some of the other hyperscalers? We're not there yet. They'll use it in-house. It's going to be used, according to Bloomberg's previous reporting on this story, for the inference part of the way that we interact with AI. So when you start to use and ask questions and start to use the model rather than the training of the model. And it's an important distinction, because NVIDIA and their GPUs, their AI accelerators, are really consequential for the training, less so for the inference. So it's not an immediate threat to NVIDIA, but it's a reminder that OpenAI, that Meta, that Amazon and others are designing their own AI accelerators because they want to be less dependent on NVIDIA. So it does tie into that story. It's significant for Broadcom, of course, which provides these chips around connectivity and particularly application-specific chips, so chips that they can actually adjust and tweak for their specific customers. And it seems JP Morgan thinks they're going to get possibly $20 billion in AI revenue for the full year 2025, and that this customer, OpenAI, is a big part of that story.
OK, so this is actually enough to kind of soothe the worries about their growth, slowing growth.
Yeah, and look, this is a company, so Broadcom, the stock is up about 30% year to date. Again, it traditionally plays in a different space to NVIDIA specifically. It's part of that story. The two kind of go together in these data centers. You open up a data center, you lift the hood, and you see NVIDIA's chips in there, and you see Broadcom's networking chips in there as well. And again, they very specifically target these ASICs, so application-specific conductors that they ship to their customers, where they can adjust and tweak them and refine them specifically for their customer needs. There had been concern, particularly after April, that growth would start to slow for Broadcom. Their guidance is pretty strong, and particularly into 2026, I look at all the analyst reactions to this. They're like, Broadcom is well set up, and that this customer that they haven't said is OpenAI, but our reporting has confirmed it is going to be consequential in that going forward.
Now, Tom, as you've been speaking, you've reeled off the guest list for Trump's dinner with the tech bros yesterday. I noted that you had Mark Zuckerberg sat next to the president himself. What did you make of it? What's your key takeaway?
There were some tech gals there as well, but no, the bros were in the majority. And it was Melania Trump, interesting, who convened this alongside President Trump. They all kind of went round and thanked the Trump administration for creating an environment, I'm paraphrasing, but essentially creating an environment that they characterized as more conducive to investments. They all committed to those investments. Apple, for example, has invested $600 billion US. And then you heard President Trump talking about chip tariffs. That's really important. He says if you're building here, if you're investing here, you won't be hit by those tariffs, but they are coming soon. Previously, he's been reported to talking about tariffs of up to 100%. So I think the question is, watch for TSMC, watch for Samsung. Those are the companies that ship the most chips into the US market. Have they done enough on the investment side to convince the Trump administration that they should be immune to those tariffs that he says are coming for the chip industry?
OK. Bloomberg's Tom McKenzie, we thank you for that roundup of that dinner. The tech gal in chief, Melania Trump. Now, to fashion. Giorgio Armani, who died yesterday aged 91, fought for decades to keep the fashion empire that he founded independent, as Italian icons like Gucci and Fendi were snapped up by larger luxury chains. Now, the future of the empire that he created is in the hands of his family and close associates. So let's get more now with our reporter Flavia Rotondi out of Rome. Flavia, for the uninitiated, just start by painting us a picture of what a phenomenon Giorgio Armani really was.
It definitely was a phenomenon because he, first of all, he combined two roles basically in one. He was the founder, the designer of his company, but also the entrepreneur for so many decades. And he managed to basically to keep these two souls basically together for so many years. As you already said, basically he created a totally different style, liberated women, as we say, deconstructing fabrics and cuts for jackets, created totally different style and an empire, because he started as a window dresser. In a few years he had his own business, and then an empire that basically spanned from high fashion to sporting clothes to eyewear, home furniture. So it was quite an incredible and unique, I would say, not only fashion company, but entrepreneur in Italy.
Yeah, truly an empire. So attention now turns to what becomes of that empire. We know that he found it hard to share control, Flavia. Can Armani survive without Armani?
That's quite the question right now, because of course he has heirs, he has a family, he has a partner, very likely to replace him, even if temporary, and there will be a will that will be read in the next few days, and we will know more. But the big question is what will become of the company after this? Will the heirs decide, the heirs or the family, to decide to sell it, to sell part of it, or to keep going solo? Mr. Armani basically hinted in an interview with us that there was possibility of a new owner at some point. So we'll see.
Okay, Flavia, we thank you so much. Up next, The Brief. This is Bloomberg.